My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but also to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We keep hearing how darned expensive the stock market is, that it's way out of whack with historic valuations, that it's extended well past what can be justified. I can't disprove that. I can't contest it. On days like today, where we flirt with record highs after so many up days in a row, Dow ultimately gaining 33 points, S&P backslid 0.11%, NASDAQ declined 0.09%. It seems pretty ridiculous. Ridiculous, frankly, that we can still go higher with the S&P 500 trading at almost 22 times earnings, way high versus where it's been historically. We don't really have a lot of grounding for being at these levels. Oh, and given how all we hear from Washington is that the president's agenda of lower corporate taxes and repatriation of vast sums from overseas seems totally held up by dysfunction and rancor in Congress, even as Republicans own both houses, is there any real rigorous intellectual justification for these prices? I know I'm mystified each day. I'm sure you are. I know that a sell-off is inevitable. I know we're due. But something keeps happening that makes us wonder whether this market might be cheaper than it seems. Companies keep beating the earnings estimates and raising their forecasts, rendering the current price-to-earnings multiples pretty much worthless. No, I'm not rationalizing reasons to buy here. I'm simply stating facts. If companies can continue to deliver better earnings than we expect, then this market might be cheaper than it looks. Maybe a lot cheaper. Take yesterday alone. Home Depot and Walmart, the largest do-it-yourself merchant and largest discounter, reported surprisingly great quarters. Not good quarters, great quarters. Both of them gave you ample opportunity to raise your estimates. If you thought Home Depot was expensive going into the quarter, you found out otherwise after you listened to the conference call. I was primed for disappointment from Walmart. It did the opposite. It showed more profitability, including online profitability, much more than I expected. This afternoon, we heard from 3M, from its CEO, Inge Thulin. He said he feels better about 2017 than he did a few months ago. 3M, Home Depot, Walmart, three Dow stocks that seemed expensive last week now seem too cheap. Too cheap on 2017 earnings. And that's even after they've run a bit. The exact same kind of revaluation occurred last week with Cisco, CSCO kind. If you looked at the previous quarter, you would have been primed for some downbeat numbers. Chuck Robbins, the CEO himself, wasn't that happy with the results. But 90 days through some big contract wins, some very positive acquisitions, as well as an improved macro backdrop, Cisco went from being a potentially expensive stock to being one that stands out at ridiculously cheap at 14 times next year's earnings. This was a transformative quarter for Cisco. It showed far greater profitability than I would have hoped for. But you had to understand that the profitability is being hidden by its metamorphosis into a software company with a hardware base. We own Cisco for ActionAlertsPlus.com, and we feel ourselves telling subscribers that the stock's way too cheap versus where the business is headed. The current price can't be justified by all the good that's happening. Cisco stock is too cheap. The exact same thing happened earlier this month with Visa. The company's quarter previous, it was a tad weaker than expected, and you might have figured we're going to get another one, a repeat. Nope. As CEO Al Kelly told us when we sat down with him in San Francisco, Visa saw acceleration in pretty much every venue, and its business has gotten much better in the last few months. If you thought Visa stock was expensive going into the quarter, again, you realized it was too cheap coming out. But it's not just earnings that make it hard to sell this market. Do you know what's the most expensive consumer packaged goods stock I follow? Another Dow stock, Procter & Gamble. Sells at 22 times next year's earnings. That's pretty amazing for a slow-growing but admittedly blue-chip company. Nevertheless, Nelson Peltz's Trian has just taken a huge position in the stock, driving the stock up. I don't think it's done going higher. The fact is, Peltz is the one activist investor where if you bought the stock after he announced a new position, you consistently beat the market, in part because he's so good at engaging management and finding ways to cut costs. Peltz was in on another Dow stock that's been roaring here, DuPont. As its deal with Dow Chemical suddenly looks like it will close soon. Yes, DuPont might seem very expensive on 2017 earnings, but not if the combined company is about to split into three separate businesses, as DuPont's excellent CEO Ed Breen has promised. When that deal closes, you go from an overvalued DuPont to an undervalued Dow DuPont. How can you say that this Dow Jones component is overvalued when it won't even exist as a company a few months from now? And this strength is hardly restricted to Dow stocks. Lately, Bristol-Myers has had an extremely hard time with its key anti-cancer franchise, Opdivo. It's been proven inferior to Merck's Keytruda in some very important lung cancer studies. The misstep has caused Bristol to lose a tremendous amount of market capitalization, yet it still isn't cheap on earnings. But what happens? Well, we learned last night that Carl Icahn's taking a big stake in the company. He's making noises about how it can be taken over. This stock trades at 18 times next year's earnings. Yet I think these estimates are more likely too high because of the eroding Opdivo franchise. I know a bunch of people shorting the stock, betting the quarter will be weak. But there's Carl in there agitating. Next thing you know, maybe he catches a bid. Then who cares how expensive it might be? Kind of reminds me of how Apple was when Icahn left the stock, thinking it would be too expensive based on, among other reasons, flagging sales in China. What a difference a quarter makes. As we saw Apple's earnings actually accelerate, service stream coming into view as a recurring revenue business, kind of like a razor blade model. What's so important about all these situations? Not one of them relies on the president's agenda to go higher. Sure, there are people who may be bidding these stocks up on the hopes of repatriation, lower corporate taxes. And I have no doubt that eventually something good will happen on both counts, given that the president and Congress support these policies. It's just that I don't see lawmakers getting anything done on the tax reform front until late this year, maybe early next year. In the end, though, every time you want to give up on a stock, any stock, seems like something good happens, doesn't it? Hey, you want to give up on Popeye's Louisiana Kitchen ahead of Mardi Gras because nobody seems to care about all the great work CEO Cheryl Batchelder's done? Bam! Restaurant brands pay $79 a share for this mid-$60 stock. Kraft Heinz, hey, disappoints on Thursday, right? By not talking about an acquisition strategy we won so much. Next day, it bids for Unilever. Stock soars almost 10 points. Positives keep coming. While the stock market certainly seems expensive, individual companies can often turn out to be quite cheap, given better than expected earnings, potential takeouts, possibility down the road of a better tax regime. So let me give you the bottom line. As much as you might be inclined to bet against this market, just remember that the indices contain individual companies with excellent CEOs who are bettering the situation as we speak, and understand that there are real reasons for this rally. Reasons that aren't going away, despite the remarkable run we've had since Election Day. Pat in North Carolina. Pat.
Booyah, Jim.
Booyah, Pat.
We love your show.
Thank you.
My husband and I are interested in expanding our portfolio, and we're interested in copper. What's your take on Southern Copper?
You know, I was going to say that I like Freeport. I do like Freeport, but they had some problems with Indonesia. Southern Copper does seem like an inexpensive stock, and I share with you some like for copper, because copper seems to be breaking out here. And I think as long as it's part of a diversified portfolio, you're in good shape. Let's go to Cody in New York. Cody.
Hello, Dr. Cramer.
Hey.
Thank you for your continuous guidance.
Oh, my pleasure. Thank you.
I'm interested in investing in the Carlyle Group stock. So it's an asset manager that lumps hedge funds together and thus subject to market volatility. I like the space because it focuses on energy, infrastructure, real estate, and credit, all sectors enhanced by Trump's policies. And yet its stock has not risen much recently, and it's still rather cheap, especially on the account of its massive 10% yield.
Well, Cody, I agree with you on everything, but the reason why it's cheap is because people don't know what it owns. But I'm inclined, after what happened with Fortress last week, after a better than expected stock market, I think you're right. I think Carlyle is a buy, CG at 16. We're going to Steve in Washington, please, Steve.
Booyah, Jim. My question is, if we ever get a pullback in the Dow of this market, would you buy Hertz or Avis?
Well, I have to tell you that if we got a pullback, there'd be so many high-quality stocks like a Cisco or an Alphabet that I want to buy, or, yes, an Amazon, that I would like to stick with companies that have improving fundamentals that actually have accelerating revenue growth. And I think that all those fit that pattern, particularly because, geez, after coming back from Silicon Valley, I feel so strong about those companies. Even when you want to, it is so darn hard to bet against this market when you got CEOs bettering their situations day after day. There are real reasons for these record rallies, people, and we'll be looking for more buying opportunities together. On Mad Tonight, it's one of the top 5 players in the amusement park industry, but are you tall enough to get on this wild ride? Get ready for an adventure when I speak with the CEO of Six Flags after earnings. Then I may have left my heart in San Francisco, but I remembered to pack the lessons I learned. Tonight, I'm reflecting on my time spent out west and telling you the 3 hot tech stocks worth owning. And last year, Cheniere Energy shipped out its first tanker of liquefied natural gas, LNG. But who was missing from the momentous occasion? the man who made it happen. Tonight I'm talking to Sharif Suki about his new business venture that's competing directly with his former employer. I suggest you stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.